Okay, I think we are live. Sorry about that. Not uncommon for me to scramble around at the last second and make it to the live stream. I don't know why. It's crazy. It just seems like I always get distracted with other work, and then just the time, I forget my coffee. Anyway, we're here. Welcome, episode 96. Of course, hopefully to all my American friends out there, election is over. Hopefully, if your guy won, congratulations. If your team lost, condolences. But I'll tell you one thing. Above everything, I think what I'm most happy about is that it was decisive. And hopefully, although, you never know, hopefully we can get back to some normal stuff. So, it's been heavy election stuff for a while. Of course, I will entertain the odd question today if people want to talk about the election further. I think today will be pretty much the last day. I usually punt on political questions, political comments. I'm not overly interested in all of that, but, given what we are facing this week and the fact that we are going to be reviewing one of the trades that we put on last week, I think that if there's anything today, I might say a few words. But let's try to get back into trading. I suspect markets will be reasonably normal for the next several months, which will be nice. I think if people remember the last time, typically after elections, people are just tired of it, and there's this lull afterwards. So hopefully we're heading towards that. But like I said, we're going to review one of the trades we put on. I haven't looked at it today, actually. I've been busy with other stuff, but it was immediately successful after the results came in. And then now I think there's a decision to be made. So we're just going to take a look at that. And I will try to, at the very least, tell people what I'm personally going to do with it. And then there's another thing. I won't really explain it until we get to that part, but I do want to kind of hit on the point of why buy and hold investing doesn't work so well. And a member submitted something to me that I ran a few numbers on, and I think people find that interesting. But of course, today will be largely just a Q&A as usual. Here to answer all your questions, volatility trading, options trading, whatever it is, off-topic stuff is acceptable. But here we go. So first thing that we should actually do is let's take a look at where it's at, right? Of course, the election was, hopefully people can see this. Let me see. I just ran to the live stream at the last second, so I don't make sure that these settings are correct. Yes, I believe you're looking at that. So yeah, obviously things were pretty rough. Let's actually look at the VIX instead, because as I explained, leading into binary events, you will typically, pretty much always, especially a major binary event like an election, you will see volatility elevate, just simply because people are going to have to be hedging. People really don't know what's going to happen. It's very normal to see a rise in volatility leading up to a binary event. And then typically, not always, if it's a disastrous outcome, it could continue, but usually what we see is a decline in volatility. And just to repeat from a little bit what we talked about last week, remember, I did plot the VIX index 30 days before and 10 days after all elections going back to 1988. And these are all of those values averaged together. So this is typically what election volatility looks like. Obviously, you see a rise, but the real rise, of course, is about 10 to 15 days out. 2 to 3 weeks is when things really start to get tense. And then afterwards, pretty much always, the only one that we excluded was 2008 because, of course, the VIX was right in the heart of the financial crisis. And the reprieve rally of volatility crush after the results came in didn't really last very long, and then the stock market crashed again. But basically, this always happens in binary events. We made a trade with the VXX Butterfly to capitalize on the fact that within about 10 trading days, all of the previous volatility is going to be sucked out of that position. So what we ended up seeing was a truly decisive victory, right? Even I wasn't expecting that. I did think that Trump was going to win. We talked about all my reasons for that. But I thought it was going to be close and maybe we'd have to wait a couple of days. Turns out it was just an absolute blowout. I think the one statistic of the election that just blew my mind was I saw the map or absence of a map where they were comparing the counties. So just little small pockets of electors, to be honest. The number of counties that Kamala Harris outperformed Biden's 2020 victory. And it was literally zero, which is just, it seems almost impossible. There was not a single pocket of any electorate anywhere in the United States where Kamala Harris did better than Joe Biden did. So, you know, I'm not on either one of the teams. Of course, I am Canadian, so none of this is really my business to even talk about, to be honest. I'm not a voter, but it was, I mean, you can't say it wasn't a decisive win. So it was pretty much a blowout. And what we saw as a result of that, which affects our investing, right? I mean, forget about election talk and all that stuff. What we saw was what I would say is an outsized volatility crush. We were expecting this to happen, but like I said, it typically resolves itself over several days of cooling down after an election. What we saw was a jump from basically here to basically the very beginning. We can see the VIX. Before the election stuff started ramping up, it wasn't uncommon to be in the teens, the mid-teens. It ramps up during the election. There's that double ramp. First ramp is, you know, maybe the monthly people buying their hedges and getting ready. You guys are not even looking at this, are you? Screen share. No, that's not it. Sorry about that. So yeah, you can see that we touched the mid-teens before that, and then this is that double ramp up where there's an initial phase of buying, hedging, you know, 30, 45 days out, and then the real hedging comes in a couple of weeks. It's literally exactly what we saw this cycle. And the volatility crush was insane. So we're already down into the 14 handle. What is wrong with my software? It's not showing correctly for some reason. We're already down to a 14 handle on the VIX, 1493, which now we can check out our trade. It was this VXX trade here. This line right there, all right, I can put both of these. This line right there was where the VXX was at when we put on this trade during our last live stream. And I said, what we are expecting is over the 10 trading days following the election, the VXX is going to go down to here. I was expecting it to go to about 45. An initial drop of $3 or $4, somewhere around here, immediately after the election, and then over the next 10 days or the 5 days, it would bleed down and we would eventually get to that 45 level. Well, we're basically there now after 2 days. So this is what the trade looks like. Initially, it was up a lot more than this. It was up like in this case, about $400. Now it's bleeding down because the VXX has come down, you know, faster than expected. So the butterfly, the risk of a butterfly is of course down on this low side. And we're approaching that faster than we probably thought. So we actually do have quite a bit of time left on this trade, which is the problem. If it was somewhere where we were expecting at about 48, for me personally, I definitely would have left the trade on if that was the case. If it worked out exactly how I anticipated, basically 2 weeks after the election we would hit this range, then leaving it on is what makes sense. Now, not so much. Now I would say, and look, some people do take the trades that we talk about in our live streams. I do want to do the stupid disclaimers. I wish I didn't have to say these things, but this is not investment advice, you know, blah, 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 all the standard disclaimers. What do they always say? You know, typically they'll say, seek out a financial advisor for advice. Don't do that. They're not going to lead you in a very good direction. But yeah, you get the point. If you did take this trade, I'm essentially just talking through that what ended up happening was it played out just like we expected, but quicker than expected. And that puts a little bit of strain on that butterfly, of course, because we still have several trading days. We've got about 10 trading days left on this. Now, if it flatlines and pins, it would stay there. For me personally, I would probably, and this is what I'm going to do, so just full disclosure, this is what I'm doing. I'm going to let this go over the weekend and then likely close it on Monday. So if the VXX happens to go up on Monday, then I would let this go for a few more days. But once this trade crosses about 44.50 on the VXX, maybe even just under 45, that for me personally would be the signal that The trade worked out almost perfectly, but of course not quite. It is bleeding down a little bit too fast. So full disclosure, that's what I'm doing. Let's just make it a hard rule. I don't like to be too waffly. So let's say as soon as the VXX breaks below 44.50, whatever day that happens, whether that's later today maybe, whether that's next Tuesday or Thursday, when that number is crossed, I would be closing this trade. Otherwise, anything over here is perfectly acceptable to keep this trade open. And of course, for anyone else who watched that live stream, I also talked about Iron Condors being potentially a decent trade. The only problem there is that you're trading VIX or VXX, and an Iron Condor is 4 legs instead of 3. So it is a little bit less liquidity as far as trading goes. So that's why we selected the Butterfly. But pretty much any trade you did, whether it was a diagonal, calendar, Butterfly, anything that we talked about that live stream, they all worked out really well. So that's what I would do. Set a hard line. And that's the thing about risk management. You don't ever want to leave it up to your emotions. Hard numbers, hard lines, actual stop losses. This just takes the guesswork out of it. So yeah, I see a comment not seeing the chart. Sorry about that. But yeah, take the guesswork out. Below 44.50 on the VXX, that's the signal to get out. Anything above that, you can just let it go another day. That's what I would say. So could very well be closed out pretty soon. Let's do something a little different today. Let's do a couple of questions, and then I will jump into the second segment that I was going to talk about. Just because sometimes by the time I get to the Q&A, there's a wall of trades. So happy Trump won. Volatility tends to be more volatile last time he was president. Bless his heart for that. Well, I'm glad your guy won. Is volatility lower during Trump? I don't know if there's any way that I could test that would be fair, because, of course, the real issue, and to be honest, we don't even know how much it affected the election, is that whatever president was in charge of COVID and the recovery afterwards was going to get saddled with a very uphill battle to win, because there was just no question that inflation was going to go through the roof after that. It was just such a major event. And I mentioned it in the live stream. Trump was president during COVID. I think people kind of forget that he was president for the first 11 months of COVID. The lockdown, he did that. The PPP loans that they just trillions of dollars just basically unaccounted for. That was happened under him. Plus, if you care, I personally don't. Vaccines is sometimes pretty good science, but he was the one that did the Operation Warp Speed, rushed the vaccine out in a month and a half. So it's hard to know where that line is to how much you're supposed to blame Trump for high volatility and high inflation, and then Biden taking over and continuing all the terrible policies and maybe even making them worse. Hard to account for who gets that, right? Same with Obama in 2008. You can't saddle him with the financial crisis, right? It happened. He took power in January 2009. By then, it was almost a bottom. So these are just the things with politics and markets and trying to assign which president is better for the markets, which better, like you're saying, which one has higher or lower volatility. Are we expecting stability because typically Republicans do X, Y, and Z? It's really hard to parse data like that because honestly, how do we even know? Things happen in the world, and whoever happens to be president at the time just gets saddled with it. That's just typically how things happen. Now, you'd hope that the presidents do a really good job solving the problem that comes through no fault of their own. But yeah, sometimes things just happen. I don't know if that's true. I would suspect if this is sort of like a leading, hey, you want to hear me rant a little bit? The one thing that I will say about Trump is that obviously he wants to win. Obviously he wants to be president. Everybody who runs wants to win, but it's one of those things, kind of be careful what you wish for, because it's certainly possible, just given the strength of this bull market and how many macro headwinds there are in the market and how uncertain things are with debts rising. And it's just been a long time. It wouldn't actually surprise me if there was a major decline in the stock market during Trump's presidency. Just, again, no fault of his own. He's just going to be saddled with the fact that you can't really count COVID as a crash because it was such a strong V bottom that it was came and went so quickly. As far as stocks go, that was a month and a half maximum. It's just been a really long time since a major financial crisis that crashed the market, stayed low for a long time. It's entirely possible that he's just going to inherit a bad stock market. So, I certainly won't blame him for it when it happens. I guarantee you Blue Team will, but it's just one of those things. The economy is what it is. I would expect at least for several months we're going to get a pretty smooth period. But of course, I always have to say this and remind people, nothing that we do within our portfolio is just me making plucking out of thin air decisions. So obviously, even though I am expecting to be in these aggressive positions for the foreseeable future, I would imagine it'll last a few weeks or a few months. We're going to be short vol here. We're going to be in the NASDAQ here. We're going to be in the S&P 500 here. I'm expecting that to last a while. I'm certainly a quantitative trader, and this only happens if the data tells me to do that. So I'm not saying that I'm just going to stay long equities, short vol, just because I think Trump's going to do that. If we have to move out into safety, next week, then that's exactly what we'll do. This is not me making decisions. I'm just speaking. Here's what I think is going to happen. I think a few months of stability, ramping into a Christmas rally is probably the most likely outcome. Beyond that, boy, I don't know. I wouldn't want to inherit a stock market at all-time highs after a roughly 13-year bull market. That's just me. I would have probably wanted to be the guy who inherited the market like Obama, kind of perfect timing. It was basically fizzling out and almost over by the time he got it. So he gets credit for that, 8 years of incredible performance. Yeah. But it is what it is. Presidents have to deal with the randomness of markets too. All right. In the Iron Condor strategy, would you review how to set price alerts on the position on toss? I don't do that, and it's by design. I don't set any actual hard stops in my trades. I open the trade. Oh, we don't have any on. I can't show you one right now. But I open the trade, and then every day I check the trade. So as you know, you've probably heard me say, I input my signals in my spreadsheet roughly an hour after the market's open, go through the whole list. It spits out the trades, then I send the email. So essentially, whatever the position is in, either under or over the stop loss at 10:45 on that day, that's the position for the day. And even if it's switched over throughout the rest of the day, I don't change. That's it. I check positions once a day. I've never found it beneficial to be checking multiple times per day, because then you get into the situation where, for example, just a tactical strategy like this. Let's say it's a threshold that's very close to the line. Okay, at 10 in the morning, I'm in SVXY. At 10:30, oh, there it goes. It crossed over. Let's get into gold. And then at noon, it's back into the SVXY. So sell this, get into that. And then towards the end of the day, there's another little sell-off, and boom, we're back into gold. So let's do that. I have just never found it beneficial to check trades more than once per day. I think longer than once per day, you can really get in trouble. Bad things can happen in 2 or 3 days, but shorter than once per day is just inviting unnecessary whipsaw and noise. So as far as stop losses go, whatever broker you use, sounds like you use Toss, you can do that on an Iron Condor. I mean, you can basically set your limit stop losses at whatever price. If you got 120 or $1.20, you can set it at 60. That's fine. You can set it at $1.80 for a stop loss. That's fine. Other brokers, they might ask you to do these, conditional orders. You can do that. I just don't think it's beneficial. For me personally, also because I always have to keep in mind that I am running a service where the signals actually go out to a community that's following the trades. I do think it's best that people enter and exit the trades on the same days that I do. Even if your personal stop loss was or wasn't breached, I still think it's better to enter and exit on all the same days that I do. So that's just a recommendation. Of course, it's your money. You can do what you want. Set your stops if you want. But for me personally, let's say I got $1.20 and you got $1.25. We are going to have a slightly different stop loss, but I would still wait for the trade signal in the email. And that way you get to track the performance exactly. If you're in the habit of trading yourself using your own levels, that's totally fine. But then you have to understand that there will be times when you close a trade and I don't, or I close a trade and you don't, and there's a little performance gap. I think that it's probably better to just wait for the signals. But yeah, not that difficult to do in TOS or IB or anything like that. Okay, the further out of the money the puts you buy in a high vol environment. Feel like I missed the intro to that. I don't see anything. Sorry, it might be my software. Can you tell me whether that will lead to higher or lower Vega crush values? I noticed 22 put UVXY went from 2 cents to $1.98. That can't be right. Is that right? Did you buy those for 2 cents and now they're $1.98? Follow up here. I guess with a move as big as we got, Vega wouldn't have mattered so much. But wondering if Vega would have mattered more if we were looking at strikes further out of the money or in the money. Well, so the thing with options trading is there's always a trade-off with the Greeks that you are looking at. So let's go to the UVXY. At the money, in the money, out of the money is always going to be trade-offs. And you can just see this, right? The deltas is going to be increasingly high the more in the money you go. But as you're alluding to, Theta or Vega, you can see there's Vega differences as you go here. And there's also Theta differences. And then there's also, if you're talking about options trading, there is always the possibility that if you go too far out and not a whole lot happens, that's guaranteed to just decay down to nothing. So you also have to manage that. You're basically looking at Delta, Theta, Vega, and trying to balance them the best way you can. So a very high Vega trade, very susceptible to the vol crush, you'll capture it all if we get what we got, is a long put option, like you're saying. But there might be problem with long put option is if you didn't get the vol crush, you're going to be in a trade that is significant headwind if that doesn't happen. So some people might say, oh, well, I think I want a lower Vega trade. So maybe they turned it into a vertical put spread where they're doing the long put, but there's a short in there as well, and that reduces the Vega. But that also increases the Theta. So it means that if you don't get what you want, you don't get punished as badly. And you're always sort of dancing on this edge of what is your risk management, what's your plan, and then there you go. Like obviously, if you're looking for the best bang for your buck, out of the money put options, if you get a vol crush, or out of the money call options, if you get a stock or an ETF that ramps, there's nothing better than that. But it also requires near perfection on your prediction. There are other ways that for me personally, my risk management, as you know, I always talk about butterflies, iron condors, even straddles, strangles, calendars, diagonals. I'm always talking about things that, yeah, if I'm right, I get the direction exposure and I make some money, but I'm always looking for, what if I'm wrong? How can I minimize my losses? So this is why I very rarely, almost never, buy long put options, long call options. It's just not in my arsenal. There's very rare that I would have that much conviction. So for me personally, obviously you saw I chose the butterfly. But yeah, if your question is, what should you do to just make the most money? If you're trying to see, like, I'll buy this for 2 cents and maybe it goes to $1, yeah, the further out of the money put options, single leg long put options or single leg long call options, that's the highest Vega you can get. So go for that if you really, really have conviction. Go for something maybe more that involves both longs and shorts if you're trying to hedge your bets a little bit. Like, what if I'm wrong? What if the election was super close? What if, even if Trump won by a little bit, they wouldn't have contested it. But if Kamala Harris won by a little bit, we would right now be in legal fights, right? So then your long put option would have been a disaster. It's up to you. I can't say which is better. I can just tell you, just mathematically speaking, best bang for the buck is out of the money, long puts or calls. Here's one. I didn't do the VXX trade. I bought SVXY instead. I mean, that works fine. We talked about that as just a very easy workaround. You don't have to look at any of the Greeks or anything like that. and SVXY had a real nice gap up as well. It's still struggling this year, right? We talked about this, that election mess in the VIX futures term structure has made it so the volatility ETFs themselves have performed very poorly, but the stock market, like you can see this section here, that doesn't affect the stock market, right? Because remember, the stock market is not the volatility space. Volatility ETFs trade entirely based on the VIX futures term structure and how those futures are moving in relation to the VIX index as you move through the expiration cycles. So in a situation this year, and I'm kind of glad it happened because it proved this point that I've been saying for years to people, that SVXY is not just a proxy for the stock market, and VXX is not just a short stock market position. It's not. There's maybe a 70% correlation, but they're not just proxies of each other. And I'm kind of glad that people saw that in real time, that yeah, stocks went to all-time highs within a percent or two before the election results were even in, and SVXY is down a ton, right? That happens sometimes. There are times when VXX, which is supposed to be inverse the stock market, there's times when it goes the same direction as stocks. There's times when they both go down, times when they both go up. So yeah, glad that that worked. But for you specifically, as soon as the election results were known, we saw the VIX futures term structure just completely normalize extremely quickly. And now we're looking at something that's very, very normal. And especially the cash VIX term structure that I like to look at, this is absolutely normal. If you know what you're looking at, let me blow this up a little bit. Anybody who's heard me talk about it, seen my videos, the 9-day VIX should be in a stable market lower than the VIX, which is 30 days. VIX 3M is 3 months, 6 months for the 6M, and then 1Y for the 1 year. This is a perfect term structure, meaning stable markets. This corrected itself extremely fast, right? This was inverted right up until the election. And same with the VIX futures was an absolute nightmare. So obviously SVIX was doing terribly, and you made a bet that there would be significant volatility crush, and SVXY is just as good for playing that trade as the butterfly that I did. I would say they're different, right? Your trade is more directional. Mine was still going to be a little bit okay if we dragged this out further, but yours is going to make more money if you're dead on right. So obviously what would have made the most money is just to short the UVIX, right? Short the 2 times long one, and those made a lot of money. But again, that could have lost your entire account if it went badly. So I hope nobody ever did that. Here's another person, long SVIX and ZIVB. Again, good calls. Can't argue with that at all. I was sort of tossing up last week between choosing basically those two plus the VIX trade, either a VIX Butterfly, a VXX Butterfly, or long SVXY. SVIX for me personally moves a little bit too fast, so I like the risk management of a half leverage, but good call. Up a lot. What was that one? Just for interest's sake, it went from November 4th. So the recovery happened the day before. I wonder if that means that certain key people kind of knew something. You always think, like, if the market moves before the news comes out and it's dead on accurate like this, you kind of think, some of the big players might have been told something behind the scenes. I don't know. Is that conspiracy theory? But it started to come up a little bit before the election. Here's the election day, and here's the results. So, but let's say from the lows, let's assume you bought it back here, sort of anticipating. So from 25 to 28, yeah, you did well. You did very well. Probably made over 10% on that trade if you bought it here. If you bought it down here, then you could have made even more than that. So good stuff. It was one of those things where, again, where's my chart? Come on, stop all the clicking. I know people hate that when I'm searching for stuff. This is one of those things that once you see the data, you pretty much know what to do. And sure, it was possible that we could have been wrong, but when you see data this strong for this long, this many election cycles, it's pretty much a no-brainer. So for all of you, see you back here 4 years from now when there's another election, because we will be almost certainly doing the exact same trade. We will be talking about the same live stream, and we will more than likely be doing the exact same trade, because it's going to happen again. This is weird. Any thoughts on the crazy VIX spike that happened in August? Was it a one-time thing or an indication something is broken with this market? So let's take a look. It was interesting, but I don't think it was out of the ordinary. It was just one of those things where I remember talking on Twitter about that. So how high did it go? 65. I don't know what happened then. We live streamed for a couple of weeks during that. Did I ever reach any major conclusions other than this is just what happens when you get something like the VIX, which is a very narrow measure, right? This is not a good measure of volatility. Like if you look, a move that big, of course it did affect certain other instruments, but at a much lower beta factor, essentially. And I think even ZIVB, for example, it's hard to say, this isn't percentages, but ZIVB did a little bit better. The old S-Vol's really weak, so it did a little bit better. But the VIX itself is just a measure of S&P 500 options activity. So there will certainly be times when the VIX just wildly overreacts compared to what you would think the stock market. Like, what was the stock market down that day? It wasn't even that bad, right? Was it, if memory serves, it was like 2 or 3%, wasn't it? It wasn't even limit down. That happens. That happened during other periods as well, where stocks go down 2 or 3% and the VIX is, it just goes absolutely crazy. It's because it's a very narrow metric. So I tend to chalk those up to nothing. If it lasted, I would have been very concerned that something majorly wrong in the market, but it was just kind of a quick little thing. And you remember, that was all off market. Like it didn't print 65 during trading. It was like the next night that's all happening. And then it kind of, by the time the markets opened the next day, everything was looking better. I think it was in the 30s, wasn't it? By the time the market opened, it would have been, like 33, 34. But I remember tweeting when it hit 65, like, what is going on? Yeah, I don't really know. All right. Closing of VXX Butterfly trade also impacts the SVXY trade, which we have currently on. Chocolate chips. I'm hungry. I didn't eat today. Closing of VXX Butterfly trade also impacts the SVXY trade, no, these are totally separate. I know what you're asking. No, absolutely separate. Our portfolio is our portfolio. That is it. It is set here, and even in our own portfolio, what we do in each individual strategy doesn't affect anything we do in the other strategies. The only one would, of course, be the volatility trend, just because it's an overlay. We're not using any margin to do those trades. That one is dependent on these three. But all of the other ones are completely independent of each other. So nothing I do with the SVXY has anything to do with the NASDAQ or the SPY. They all have their own metrics, their own signals. They all track. Sometimes one of them's short vol and the other one's in safety. Sometimes two of them are in safety and one of them's aggressive. It does happen. So obviously there's correlation, but no. And certainly in this case, that VXX Butterfly trade was 100% out of our portfolio. Had nothing to do with it. We were just playing, right? There's an election coming up. I wanted to share that data with everybody so that everybody can get a winning trade. It was just purely for fun. There was nothing there. So no. Okay, we'll do one more, and then I want to talk about that buy and hold thing real quick, because I do think it's important. I tried your butterfly idea with a 45 peak, same as mine, but toss missed one leg. What? It is a computer. It would be odd if it missed a leg on you. So I switched to a 46-48 bear put spread. That's fine. Yeah, it returned 120%. Awesome. Yeah. I don't know how that could have happened to you, though. I mean, they are computers. It would be just the most bizarre thing in the world. If you entered a butterfly and it didn't buy one of the legs, crazy. I don't know. I can't speak on that. Possible. Never heard of it happening, but stranger things have happened. You know, computers mess up. There's data errors sometimes. But I'm glad you kind of righted the ship and made that one. So your trade there, not as good as a long put option, but better than the butterfly for sure, because yours is going to be more long Vega. My butterfly is obviously going to be neutral. So there was some benefit to the vol crush, but not very much. I was essentially, mine was a time trade. I basically needed the vol crush to happen over roughly 5 or 6 days would have been nice. And it happened in 2. So that's not going to be great. But yours, 46, 48, sort of in between a long put and a butterfly. You had the volatility crush, but not as much because you did have a short strike in your trade as well. So that's the fun thing about options trading is that, like, you know, stocks are very binary. You're either long or you're short, and there isn't a whole lot to do. With options, you can just, limited only by your imagination. You can structure your trades any way you want. Yeah. What else? This is an interesting one. Nope. But I've talked about it before that the only reason I'm turning 50 in a few months. So the only reason I'm not on TRT is because somebody asked me about it. Why am I not on TRT? It is because of that. I've heard internet, YouTube videos that you can lose your hair, and I'm actually trying to hang on to my hair. So no TRT just yet, but if in a couple of years I lose the battle, then getting jacked it is. Then the trade-off is worth it. But right now, got to try to hang on and win the battle as long as possible. All right, so what did I say? I was going to do... Let me click around here a little quick. So like I said, somebody sent me a portfolio idea, and I'm not going to be super specific on it because I don't know for sure whether they wanted it shared. They mentioned to me that it was an idea from somebody else, and I checked into that person, and they do have a rather large following, so I don't want to share any super details. But they essentially sent me a portfolio idea for these positions. So I believe that I don't think I'm overstepping by sharing the ETFs themselves. I'm just not going to share the details of the actual portfolio, but it's those assets. So you basically got stocks, S&P 500. BTOL is an interesting one. People love it, but it's actually, just in my personal opinion, kind of garbage. It essentially goes long the low beta, more stable stocks, and it goes short the high beta stocks. And just for me personally, just conceptually, I know what they're trying to do. They're trying to do, pair these off against each other where they're under the impression that the low beta stocks will probably outperform the high beta ones because you're long this one and you're short the other one. But in this day and age, in this market, it is not uncommon at all that the high beta stocks are actually the ones that rocket higher. I mean, that's why they're high beta, because they're rocketing higher and they're very volatile. And, would you want to be short those ones? No. So I don't know. I just don't love BTOL personally. There's gold. VGT is basically tech. VHT, healthcare. VDC is what? Consumer staples. Then there's bonds. DBMF and KMLM. These are both interesting, but I don't use either one of them because I am my own risk manager. But these are managed futures funds. So they're essentially designed to do well if the stock market doesn't. That would be the goal anyway. They typically run about, pretty close to 0% long-term return, but they are designed to do, manage futures, do a little bit better, boost a portfolio, smooth out performance, things like that. So this is the portfolio, and these are the results. So my general point has always been with these buy and hold portfolios is that people just don't seem to... I don't want to be rude here because everybody's trying their best to take these portfolio ideas they have and try to beat the stock market. And they always think that there's some type of magical allocation of varying asset classes in different percentages, 15% in this one and 20% in that one. And the key is the managed futures and the commodities. And everybody kind of thinks they have this magic formula that somehow you're going to slap them all together and it's going to outperform the stock market. That's what everybody's trying to do, is beat the stock market. You know, nobody really wants to hold the S&P 500. It does return a 9%. That's not that great when you back out inflation, which is about 5%, regardless of what the government tells you. It's 5% inflation. It's not a great return, and you have to sustain 50% drawdowns to get that 9%. So it's basically a non-starter. So everybody's trying to get this buy and hold portfolio that they don't really do anything, maybe a once a year or twice a year rebalancing, but they're trying to beat the stock market. And nobody, I wouldn't say nobody, but some people are resistant to the idea that I always tell them, it is literally mathematically impossible to beat the stock market with those buy and hold portfolios. It can't be done. And I'm not saying it's difficult. I'm saying it is literally impossible. The reason that it is impossible, and I hope I'm able to communicate this in a way that people get it, all of these asset classes underperform the stock market. Every single one of them. So how is it possible to take something like the SPY, which will return 9% long term, and all of the other ones return anywhere from 3 to 9? How is it possible in any combination or any allocations to take something that returns from 3 to 9, average it all out, and make it equal more than 9? That's not how numbers work. That's just not how math works. It is impossible. The only way to beat the stock market is two ways. Invest in assets that outperform the stock market, or don't hold the assets when they're doing poorly. Tactical investing. So that's what I do, of course. I don't hold assets just buy and hold long term because, of course, I know that, sure, short volatility is great 60 or 70% of the time, but we know for sure when volatility elevates, short volatility doesn't do well anymore. So yeah, exit the short volatility trade before that anchor gets thrown out of the back of your boat. You're just dragging your performance. Same with NASDAQ. Nothing wrong with NASDAQ in a bull market with mid to low volatility. But as soon as that's not the case, why in the world would somebody just hold on to it and think, oh, I've got an idea. Why don't I also hold bonds? I'll hold stocks and bonds at the same time, and now when the stocks crash, aha, now I've reduced my drawdown. Yes, but you're now holding bonds during a bull market when the Qs are doing well, and that's a lower return. So something like the VBinks, 60% stocks, 40% bonds, it does have a lower drawdown than the stock market. S&P had a 56% drawdown, financial crisis. VBinks had a 38%. So you might think, well, there's the winning ticket. All we have to do is just hold both of them at the same time. Well, the VBinks underperforms the stock market long term by about 2 to 3%, obviously, because bonds do. So you can't hold both of them if one of them performs less than stocks and have them somehow add up to more than stocks. Again, not how numbers work. So portfolios like this, I understand the methodology. I understand what people are trying to do. And if your goal is to reduce stock market drawdowns, then this is the ticket. This would be fine, right? The Ray Dalio all-weather portfolio, cool, do your thing. Anytime you're including assets that do better than stocks during a crash, you're going to be reducing your drawdowns. So that's fine. Get the managed futures in there, get the gold in there, get the bonds in there. You will have a much lower drawdown than the stock market. Instead of 56, maybe it'll be 30, right? If that's your goal, then go for it. But you have to know that you're also going to get 2 or 3% lower return. And then when you back out inflation, you might find that you're in a little bit of trouble, because there is no way to turn all of this into something that's better than just holding the stocks. It's going to be 2 or 3% better holding the stocks. That's just how this works. Now, it's been a reasonably tumultuous period the last 4 years, so it's only underperformed by 2%, but I suspect long term it will probably underperform by about 3%. So what's going to happen? Well, instead of 9%, it's going to be 6 or 7. Well, that's kind of a problem, isn't it? Because inflation's 5. So really, you're only getting about a 2%, maybe 3% return on your money. But you have to also factor in the fact that starting today, November 8th, 2024, stocks are at all-time highs. Why would we expect that the next 20 years that stocks are going to make 9% a year? It's just not going to happen. When you market at an all-time high, you have to assume that it's going to be less than the long-term average. Otherwise, that would be incredible performance. Going from an all-time high 20 years forward and still getting the long-term average, that would be incredible, but I just don't see any reason why that would happen. There's too many macro headwinds. There's just too much going on. So that 6 or 7% that you'll get with that portfolio, while true, it's a lower drawdown, smoother experience. You won't pull your hair out when you're down 50%. That's probably not going to happen. You got the managed futures in there. You've got gold and bonds, and should be fine as far as risk management. But 6 or 7% at best, probably 4 or 5 if you factor that we're at all-time highs today. Inflation's 5. You made no money, right? This is how these things work. And it doesn't seem to matter how many times I show these things, that there just is no way to mess around with stocks but not exit stocks and make it better than stocks. It doesn't work that way. You've got the all-weather portfolio, Ray Dalio. Cool, you're underperforming inflation. You're losing money. You're literally getting a negative rate of return by doing this, right? People sometimes don't understand that nominal versus real, this is everything, right? Inflation is 5%. That is the benchmark. If you don't get 5% a year, you lose money. This is lost money. HFRI hedge fund index, it's going to break even. The short vol index, break even. 50-30-20, because it's 50% stocks, yeah, you could expect to make a positive alpha with that. But like I said, it's 8.1 since 2012 during a super strong bull market. I would not be surprised at all if this goes down to 5 or 6 in the next 20 years. Just not realistic to go from an all-time high and just keep going to all-time highs. So again, this is going to be just painfully self-serving, but the reason that we have outperformed, and not every year, by the way, there are plenty of years, if the stocks do well, then we're going to underperform the stock market. That's how this works. This is what investing is all about, that people don't, again, they're not always connecting the dots, but if you invest the way that I do, actually picking up that anchor out the back of your boat and just put it in your boat for a while and trying to continue your forward progress by selling stocks when they're not expected to do well, by selling gold when it's not appropriate to be holding gold, by making sure that we have portfolio allocations to go long volatility during a crisis. When you do all these things, it doesn't always work all the time on a short-term period. There are times when the stock market dips, it looks like trouble, volatility elevates, we exit to safety, and then the stock market bounces and goes right back up to the beginning. Well, guess what? We just lost 2 or 3% in that little turnover. We call that whipsaw. We get whipsawed. And in the last 3 or 4 years, whipsaw has been a little bit higher than normal because the stock market has looked incredibly weak. There's been volatility spikes, several of them, quick, sharp volatility spikes that settle themselves within a few days. And then every time it happens, you get little paper cuts. But the point is, and again, pretty self-serving, the only way to beat the stock market is to do something different than the stock market. You can't throw a bunch of assets in a pile and expect it to beat stocks. It is impossible. It's not how numbers work. So whenever, I'm not saying this to say, hey, stop sending me these portfolios. Continue sending them. I don't mind doing the work. That's another thing I've noticed, is that a lot of times people don't actually run the numbers. They look at the prospectus, or they read the tweets of the person, or they read they watch a video of the person explaining the methodology and why they're doing this, and how come 20% in managed futures, and how come this. It all sounds incredible, right? If you listen to the asset manager explain their own work, sounds amazing. So it's actually really not that difficult to just put it into a spreadsheet and just look at the numbers. And so I don't mind doing that for you. I really don't. But what you have to understand is that unless you're going to send me a portfolio that genuinely has something different, it's all going to be the same. Every single one of them is going to look like this. That's what they're all going to look like, because all you're doing is shuffling assets around. You're not exiting them in a timely way. You're not adding long volatility only in a crisis. There are portfolios like, I think it's the Dragon portfolio that has like constant exposure to long volatility. What a terrible idea that is. Who thought that was a good idea? Long volatility only works about 3% of the time. And 97% of the time, it's just a big anchor you throw out the back of your boat, just dragging your whole thing down. Who thought that was a good idea, to just have a constant long vol exposure all the time, right? Is it really that difficult to understand that during really strong negative backwardation in the VIX futures, that's when you go long vol, and all the other times you don't? I mean, it's really kind of basic, right? So sometimes I just don't get this. When I look at these portfolios, it just doesn't make any sense to me. Why do you have to buy and hold? We don't trade often. My portfolio, we're not day traders. We trade, ask anybody in the BTS community, we trade a handful of times a month. We're not talking about just cycling and rotating out of trades constantly. A couple times a month is all that's necessary just to sidestep the major events. It's frustrating to me. I've made a lot of videos about why buy and hold doesn't work, and I appreciate everybody's effort on trying to find that perfect, that just the magic formula of buy and hold, that no, this one will work. This is the one. I'm sorry. They just can't. So there you go. There's the numbers. I would say that for the person, I'm sure you're watching, this is basically for you, there's nothing inherently wrong with what you showed me. It's fine. Is it better than hedge funds? No, it's the same. Is it better than Ray Dalio's? No, it's the same. Is it better than the cockroach or the couch potato or all these things? No, they're all the same. They're all the same. The 5, 6, 7% return minus inflation, you might make 1% or 2%. All of them will underperform the stock market, guaranteed. Just stretch it out. It's guaranteed. That's the problem, is that you've got 95-ish, just number plucked out of thin air. I don't know if that's even true, but let's say 95% of the asset management world that are buy and hold pie chart investors. Obviously, 95% of all financial information you will ever consume on Twitter, on YouTube, the blogs, Substacks, all of it, 95% of that information is being written and disseminated by people who use buy and hold portfolios. So obviously they're going to be selling their book, right? They're going to be telling you, oh, the best way to do this is just to slap these 6 assets together and just hold them long term. You can't beat the stock market. Don't even try, Of course that's what people are going to be telling you, because if they don't tell you that, they don't get paid. So, it's unfortunate that the financial industry is so lazy. What I've always hoped for is that everybody shows performance and everybody tries to beat the stock market. Under those conditions, it would be highly competitive, and you could actually see, okay, this person has this strategy that's different than stocks, and it's doing, X rate of return and this drawdown. But unfortunately, almost nobody's trying to beat the stock market. Everybody's convincing you to just buy and hold and make 7% a year, and they don't tell you about the 5% inflation. They don't consistently remind you that you have to subtract 5% of that. They never say that. They always say, you'll make 7% a year. How come they don't say you'll make 2%, right? It doesn't sound very good in marketing materials if they say, look, this portfolio historically, let's show you a back test. Look at that, it made 2% a year. They don't do that, do they? They don't back out inflation. They will tell you your portfolio will make 7 to 8, always. They won't tell you the fees. They don't include those things because then they wouldn't have a job. So this is essentially what's happening in the financial industry, is that people are talking their book. I'm talking my book. When you come to my live stream, you will only hear me saying positive things about tactical investing. You will never hear me talking about the benefits of buy and hold. That's not what we do here. When you go on Twitter, you will never see people talking about the benefits of tactical investing. It is all buy and hold. If you buy a book from Tony Robbins about investing, he will only tell you to buy and hold the stock market because that's what his financial firm does, is buy and hold the stock market. If you go to Dave Ramsey, he will only talk his book. He will tell you, don't ever take a mortgage, don't ever buy a car, that's what he does. He's not going to tell you that there are effective ways to use leverage to your advantage. That's not what he does. He talks his book, which is fine. That's his business. But you have to be conscious of the fact that nearly all financial advice is coming from people that aren't investors. They're not traders. They're not exiting to safety ever. They're buy and hold. They just take your money, onboard it, put it into these portfolios, rebalance it once a year, and collect the fees. That's the gig, right? So you're never going to hear any other things. No asset manager is ever going to say, by the way, just so you know, this is probably what you're looking at. You're probably actually going to be extremely disappointed. You're going to give me 30 years of fees, and at the end of it all, you're going to make maybe 1% above inflation. When was the last time you heard a Wall Street banker tell you that, right? It's never going to happen. So here we go. That's a pretty big run. Maybe we should just call it there. Hopefully I got my point across. But yeah, keep sending them. I'll crunch the numbers for you. I'll do it on a live stream. I think the more times I say this, the better. And look, I'm not always saying, I don't even mention my business most of the time. You don't have to invest the way that I do. I'm just telling you not to invest the way they do. That's it. Find a different way. My style is one way that you could do it. Tactical investing, I always add the through volatility targeting because my entire work is based on looking at volatility metrics, deciding which asset classes perform best and worst when priority ranked within those volatility ranges. That's what my work is based on. But if you don't like what I do, you can still watch my videos, tune into the live streams. It's fine. Go be an options trader. Go do something else. But just don't do that. Please, just don't doom yourself to 25 years of 1% return because you didn't really know that it adds up to such a low rate. It's just mathematically impossible to beat it. So either hold the stock market and try to get your 9 and just hang on for dear life when there's a 50% crash, and hopefully you don't do something stupid and panic sell at the bottom. I mean, I don't know who has that level of risk tolerance to see their net worth go down 50% and still wake up the next day and keep going. I don't, but either do that, do tactical investing, do option trading, or don't invest at all and just don't risk your money and do something else. Sell investment properties, do something else. I don't know, use that money entirely and invest in yourself. Start a business and dump all your available capital in your own business and, build towards retirement through a higher income. That works too, but just don't do that. That is stupid. Those buy and hold pie charts, it is mathematically guaranteed to underperform. So you've got 5 or 6 choices, that being by far the worst one. All right, let's keep going. I just saw this, and now you've jogged my memory. The VIX stuff, the crazy VIX spike. This is what it was. I remember this now. There was something about the Japanese interest rates were shifted, and a whole bunch of people just were really offside with their carry trades. I think that's what happened. I'm not really a macro guy, so I remember being a little bit confused when it was happening. Who did I go to? I read somebody's article. It was really helpful, kind of explained what people are at least trying to do with the carry trade and all that stuff. Yeah, that jogs my memory. That's what happened. It was, the Japanese yen carry trade was something that was working for so long that I think just a lot of people were probably not only doing it, but leveraged and exposed way more than they should have been. And just like that, overnight, it flips on a dime, and yeah, the VIX shoots to 65. Yeah, that's what happened. Doesn't affect us, though. We just check volatility levels and put our capital into the positions that historically do the best during those volatility levels. I suppose it's not rocket science, but it's unbelievable how few people actually know how to do that. So Crazy, crazy. Yeah, yen carry trade for the August VIX spike. Yeah, I don't know how did I forget that? That was actually, yeah, you're right. That was a crazy event. Now that I'm sitting here thinking about it, that was crazier than I played it off to be, for sure. I remember being legitimately scared that the market was broken. I anticipated you getting back into SVXY. Yeah, like for me, so for anybody who doesn't know or isn't in the community, we actually exited to safety for a couple of days and just went straight cash. And I almost never do that. The last time we did that was during COVID. We just, in February when things were kind of ramping up before the ugliness, we just moved to cash and we ignore, 0% the whole time. It didn't affect us at all. Would have been nice to capitalize on it. Of course, the signals actually did get us to long vol, but live and learn. I won't do that again for that long period of time. But yeah, we exited to cash. And because I'm a tactical investor and I look at actual quant signals, it's not just me using my gut, I have to wait until we actually do dip into the SVXY range, which happened yesterday. So it was, what was yesterday, the 7th? 6th basically was when the major crash. So we probably missed it by a day, but I have to wait for that. I can't front run anything because, like I said, it could have been the opposite. It could have been a contested election, and then we'd all be sitting here talking about, well, what does this legal case mean, and what does that mean, and who is president? Yeah, crazy stuff. This I always punt, but I'll put it up on the screen for people. Oh, wait, no, this is different. Can you speak anything into your VIX strategy and how it did? Oh, yeah, you're kind of asking about VIX options. I don't answer that. It did fine. The volatility crush affected me because my strikes were centered around about 18. And so it wasn't perfect, but I will probably break even this month on that strategy. Again, I don't front run. I don't like super, back of the book explanation is if you set up a large structure on the VIX and then you hedge both sides, let's say the VIX is here, I try to keep my tent at or near where the VIX currently is. I don't do the whole, well, I think in 5 days it's going to be 4 points lower, so I'm just going to put the thing over there. I've learned over the, nearly 15 years I've been trading the strategy to not front run things like that. I had a very strong belief that we were going to see some major volatility crush, but I just don't want to be that kind of trader. I've tried that in the past, trying to overlay my personal predictions and opinions. It's just not my style. I do prefer to just stick to the numbers. My options trading is discretionary, but even for that, I try to not front run anything. And, so I hedged the low side a little bit. I bought a ton of put options. Cost about 4 cents. I bought just a ton of those, way out of the money. I think I bought the 13 strike, just a bunch of those, but it helped a little bit. But yeah, it's probably going to break even. It's the type of strategy that I'm targeting anywhere from like -2 to +4 monthly, pretty consistently in that range. Averaged out to about -1 to +2 because sometimes you get winners and losers. So really up 1 to 2% a month is my target. 24% a year forever would be fantastic. Yeah, this is all bringing it back to me now. Firms went out of business. That was right. There was a couple of those firms, sort of major ones, that just absolute belly up. Yeah, absolutely. I don't know how I forgot that. How much portfolio allocation your VIX option program will be, or will be independent? Yeah, it's always totally independent. So for me personally, 20% of my cash, or whatever cash that is, my entire portfolio, all of everything I have at IB, it's 20%. My VIX option strategy is my highest allocation in anything that I do. So if you, I hate talking about it because the course isn't ready yet. So, I'm basically teasing something that's several months away from releasing. But you can see here, we got 25, 25, 25, 25. This isn't everything I do because roughly 40% of my capital is in my option strategies. Plus, I tend to use some margin as well. So you could argue that it's maybe 50%, but certainly 40%. So this 25 is probably closer to 15 if you're talking about my actual portfolio. So this whole thing adds up to 100 at VTS, but it's actually about 60 of my capital. And VTS options will also add up to 100 for those options, but it's actually about 40. So you could view what I do as a sort of a quasi 60-40 portfolio. 60% is the VTS tactical rotation strategies, and 40% is discretionary option strategies. Basically, let's just call it 10 strategies accounting for 100% of my capital across 2 businesses. The only reason that it has to be divided is the audience, right? For me, tactical investing and options trading go hand in hand. I see no differentiation there. The only reason that there's a VTS and a VTS options separate is because I've tried to do both at the same time. If you recall back in, I guess from, trying to get it right, what is it, 2016 or something, all the way up to 2021, we tried to do it all in the same community. And I just had a ton of complaints from people who, if they're used to trading ETFs, every time I write a blog about options, they're like, this doesn't apply to me. I don't trade options. It's just annoying that every second day I log into your emails, it's about option trading. And then I get the other people that they're only interested in options. They're not interested in tactical investing. And so they're emailing me like, can you chill out on the tactical rotation stuff? Talk more options more. So we basically just had to split the communities. And so we split the communities, and then I actually got too busy and I had to choose which one to continue and which one to close down. And I chose to close down the options. So that's why that disappeared a couple years ago. But it will be back. I've hired a video editor. I'm doing better answering emails. I've got a pretty solid database of videos and live streams that I can point people to. If they ask a question, I can say, well, check this out. So my email burden is getting, let's say, slightly lower than it used to be, but to be honest, not a whole lot lower. But yeah, I've got a little bit more time. So we're going to go back to trying to do 2 communities, and I don't know when. Your next question is when? I don't know when. Let me just head that off right away. I don't know when. It's going to be way over 100 videos. So if each video takes 10 hours, you're talking about, you know, a pretty big commitment, 1,000 hours to build a course. And I already have a full-time job with VTS. So I don't get to work 10 hours a day on VTS options, unfortunately. If I could get it done in 3 months. Unfortunately, I have to manage VTS plus my own investments, which I spend several hours a day just testing and tweaking and doing my own work. I just don't have 10 hours a day to build options. So it's slow. It's coming along, though. Let me say that there's progress being made. I'm in Dubai right now alone. Here's my wife. She's watching the live stream. I have done it again. I have ducked out into my cave, so she's not that she's not invited. She could come if she wants, but it's just going to be me morning till night working for the next 3 months. I have zero social life at all. I won't go to the golf course. I won't do anything. Work out and work. That's all I'm here for. So I'm in Dubai. She's back home in Taiwan, and the sole purpose is I'm coming here to enter my cave and try to, bang out as many of these videos as I can, because when I'm back home in Taiwan, not saying that, she's a drag, but we hang out. We like each other. We're best friends. So we do a lot together. And then things here and there, it costs me an hour or two a day. So I'm here to just say, this needs to get done. So here I am by myself in Dubai again. Yes, please, thumbs up, everyone. I never ask, but do all the algorithm stuff. Helps me out a ton. Last question, I believe, unless people jump in. In theory, when VXX was 45 at end, it should make like 3 times money. Yeah, looks to be. I think we risked about, over here I risked 576, and it could technically make 1,800. But that's not going to happen. I mean, unless the VXX goes up next week and then down the following week, which is, of course, could easily happen. The VXX being at 45.37, technically speaking, if it was just a normal market, we wouldn't be expecting it to go much lower than 44 over the next week or two. That vol crush took care of a lot of it. It was all pulled out there. So for it to vol crush again down to 40, very unlikely. But now that I've said that out loud, the trading gods are going to punish me, and next week it'll be 40, right? But I mean, if that happens, then great. My actual portfolio is net short vol, net long equities, so I'd be fine if this drops to 40. But yeah, you could technically. That's what's great about butterflies is I always say, if you trade one, you're not going to have much success. Throwing out a butterfly, if you say, oh, I'm gonna take a trade and I'm gonna throw out a butterfly that covers, this range. Well, you're probably not going to have a lot of success doing that, right? It's just a single standalone trade. You might hit it, you might not. But what happens if you start doing a whole bunch of trades, like this, and you're just leading, you're allocating capital and leading with a whole bunch, you get the point, a whole bunch of different trades. Now all of a sudden, you've got a really good probability of just tracking what the VXX typically does, right? You can imagine that if you get a period where it's just doing this and you're just layering butterflies the whole way down, well, now you're onto something. But one single standalone trade for an election, it's not always easy to hit these. So sometimes when people get into butterflies for the first time, they'll put on one or two and maybe they won't work. And they'll think, oh, this is stupid. I put on a butterfly and I needed it to hit in this range and it didn't hit. So now I'm out money. That's a dumb strategy. They don't see the potential inside where I'm not talking about one trade. I've got, my volatility trend, for example, we are supposed to be taking more and more trades. It's just people hate the strategy, so I don't put trades on often. But within my VXX options, I do it all the time. Massive, repetitive layering of positions. Small allocations, many of them across different time frames. Now you're onto something. Now you start to get the law of large numbers in your favor. You might start getting 15 winners for every 7 losers. And over time, that's going to be adding up to a good profit. So that's the key potential there. It's not single trades, just, this one, it seems to work out okay so far. It vol crushed a little bit too fast, but that's not the key. You're not going to have much success if you do one butterfly every 4 months. It's just not, you're not going to hit your numbers. Layer. Small trades layered over and over. Wait 3 days, 4 days, put on another one. Wait 6 days, put on another one. Something happens, vol spikes, put on another one. Let's see if there's any more here. Seems to be it. Uh-oh, I think my wife heard what I said, that I've abandoned her in Taiwan. And now I have to call her back and reassure her that it was the most painful thing of my life. And I almost died when I left. It was just... yeah, it was like going off to war. All right, so we'll see you everybody next week. I'm sure there's going to be a bunch of new questions. And like I said, just for that trade, 44.5 is the number. If it dips below that, probably time to bail on that trade. Hopefully it can hover around 45, 46 for a week. That would be fantastic, but we will see. Markets are markets. All right, cool. Good night.